You are set to go.
All
Thank you so
right.
much, Deborah, for joining us today. I appreciate you so much. Um, this training is going to be on mortgage insurance, and Debra Irving is going to go through lots of different options and explain to us how we can actually help a loan qualify when there's different options of mortgage insurance rather than just doing the monthly. So you can take it away, Deborah, and I'm going to mute myself. And I just ask if you have to take any calls that you make sure you're all muted as well. Go ahead.
Hey, well, good morning, and thank you so much for having me. I appreciate it. So I'll tell a little bit about myself. I actually originally come from the lending side of the business. I've ran fulfillment primarily in wholesale and retail environments. I've done sales and operations. I did a little stint in appraisal management and with LandSafe through Bank of America. And then I have done a little bit of regulatory, which that was an interesting piece, but of course that was during the crash. But most recently I joined Radian. It's not quite 2 years yet, almost a year and a half or so here on the MI side. And so what I try to do is just offer information that I think will help with those on the lending side. And it's interesting that I'm on the MI side, and there's different tools that I had completely forgot about that I had probably utilized back in the 90s. So it's great to be able to try to provide information that I think is a good tool set for you whenever you're trying to qualify borrowers. Now, I do want to, just put out there that obviously a lot of this is more whenever you're doing retail based. If you are doing wholesale, obviously you've got to be compliant. So anything that I'm telling you today, I want to make sure that everyone knows that you need to always check back with your internal compliance department and with your investor if it is something that they accept. So what I'm presenting today are the tools that Radian has available to you. But again, you still always have to go back and rely on your compliance department and your investors if this is something that they will accept. So I always want to clarify that because again, every organization is different. So I just want to make sure what I'm presenting is like I said, the MI options that are available and out there for you. So just want to share that. So as you can see, hopefully, can everybody see my screen? Just say yes. It looks like we have 4 or 5 people, but just say yes if you can. Feel free. Yes. I'm pretty open, so this will be as casual as you like it, because I'm pretty casual. So, all right. So what I want to share with you is understanding. So obviously, the probably past 10, 15 years, probably everyone has just picked borrower paid monthly MI. Well, with rates going in the direction that they're going, much like what me and Sandra were talking about, even hazard insurance impacting the borrower's monthly payment to qualify, you've had to get creative, right, to get DTIs in line in order for the borrower to qualify. So what I want to talk about today is looking at our borrower paid single premium and our split premium. And we now actually have what is called customized. And actually, Sandra, I think the last time I did this presentation, we did not have customized. So I'll go through that with you as well. I do have a presentation. I don't always follow just the grid because I like to, talk through options. But again, today I really just want to focus on giving you the tools for the borrower paid single premium option is where I want to, really focus on today. So, and as you can see, that's the same thing I said here on the slide. So what is a borrower paid single premium? It is just that. It is a one-time single premium that the borrower has to pay, and that can either be paid in full or it can be financed. So one of the options that you have, if you have a large seller credit, this would be a great opportunity to completely buy out your borrower's MI. And then that does not go, obviously, then you don't have the monthly payment, and that helps your DTI. So one of the things that I think a lot of folks have been using lately is the buy down option, which is a great option. Don't get me wrong, I think it's a great option, but that is not something that is permanent. Buying out the MI is something that is permanent. So if you have enough seller funds, or even if the borrower wants to pay that, they can pay out, buy out their, completely pay their MI up front and be done with it. Now, one of the things that I like to talk about is whenever you're looking at it, and as you can see here on the slide, it shows here, single one-time premium payment as closing cash out, may be financeable or paid by interested party, use of excessive seller funds or builders, may lower borrowers' monthly mortgage payments, may qualify for larger loan amount due to the mortgage payment. And I'll talk a little bit more about that as far as MI, compared to an FHA loan. I'll give you some examples about that as well. Possible lender or buy up with lender credit. And so those are all your options as far as, buying out the single premium MI. And so here you can see on the next slide, we're talking about the cash or the finance. And I'll give you a couple of examples on the cash. Obviously, if you have seller credit, mostly builders are the ones that are giving the credits today. So if you have a large builder book of business, that is usually a great area to kind of look at buying it out. And then also the finance option. And so I'll give you an example of the finance option, even compared to an FHA loan. And I actually have, pull that up for you. Well, we'll get to that at the end. I'll show you that in the end. But actually, there's a lot of times that if you price out the single premium, then it is sometimes cheaper than an FHA loan. I priced out with a customer of mine in Utah, and he was going to put the customer on an FHA loan, but our single premium was 1.04. It's not always that cheap. It just depends, again, because obviously pricing of the MI is very dynamic today. But that is always something that is, an option. And for this particular customer, obviously, it saved them. He had enough seller credit to buy out the MI for the 1.04%. And then obviously you don't have any monthly MI now because it's completely bought out. So those are some of the different options that are available to you that I think a lot of folks are not necessarily looking at whenever they're qualifying a borrower. We kind of get stuck in our lane that, oh, it's an FHA, let's, because they're an FHA borrower, let's put them this way. But you may have that person you're putting in an FHA loan thinking that you are, doing them a favor because of the low down payment when there may be an option on the MI side. So I just encourage you to always check that out and see if that is an option, and that if it fits your, like I said, your internal compliance and your internal investor guidelines, then you should, maybe check out our pricing. So those are one of the things that I always try to encourage. Again, this is just talking about the single one-time payments up front. The other piece about the single one-time upfront is whenever you are pricing it out, you need to make sure that you are selecting the refundable option. And I'll show you a little bit later a refundable grid, because much like it is a premium, if you select the refundable option on MI, you can get a refund to your borrower up to 36 months. And I'll show you how you can do that and how significant that is. I'll give you a quick example. I had a customer that reached out to me a couple weeks ago, and they had closed their loan in November of 2023, and they were getting ready to sell their home, and they thought the lender had selected refundable option, and their lender had not. And the difference in the cost at that time between the refundable and the non-refundable MI was $500. And that would have equated $9,000 being back into the customer's pocket had the customer picked the refundable option. So I always encourage you to select that every single time, because that's the best option for your borrower. And as you know, I mean, we're in an environment right now that every customer you have, you have two customers, because rates are going to come down and you're going to be able to refinance them. So that is my, one of my biggest items that I just try to encourage folks. I'll always price out the refundable option. And I know it's not always easy in your system, but I had a call yesterday with my group, and I'm going to get a job aid. I don't have it today, but if you're an Encompass, there's going to be the ability for you to customize the pricing and be able to select the refundable, the non-refundable, and actually get that and not have to go outside of your LOS and pick your pricing. But either way, I think it's still advantageous to look at that, especially whenever you have a customer who is maybe tight on ratios, or you have a lot of seller credits available to you. I just think this is a great opportunity to get creative in getting your DTI where it needs to be.
Debra, can I ask you a question on the refundable real quick?
Yes.
So I have used this many times when I work for a bank, which it worked beautifully. Now, how long, generally speaking, is it refundable for? I realize that it will be based on your loan to value, but when is it not going to be refundable anymore, generally speaking, let's say on a 95 LTV? And do you know if it's up to the servicer whether it's refunded or taken off of the balance of their principal interest on the loan?
Yeah. So so one thing I do always have to say, whenever any portion of the refund, whether the MI is canceled, all of that is determined by the servicer. And I think that's another misunderstanding I think that's out there, is that they, everyone thinks that maybe we are the ones who make that decision. We do not, because so many things can happen to the loan between the time they closed and now, right? So we rely on the servicer to tell us. But I'll give you an in general, and you can kind of see here. So this is the column E on this chart, which I can share out with you, which shows our refundable schedule. So our column E is whenever it's not HPA. So HPA is obviously, any time that it meets the, Fannie or Freddie guidelines as far as automatically being dropped off.
I don't think we're seeing the right slide, Debbie. Maybe it's on another slide.
Okay. Let's see.
Potential. We're on single premiums, so.
But you are still okay. Hold on. Let me see. Let's see. I apologize. I'm trying to get to that point of sharing the screen. It's not letting me change. I'm sharing. Okay. So right now, this is what all you're seeing is the single premium.
Yeah, that's what I'm seeing. Just single premiums.
Okay. So I popped in this screen, and on my screen it's showing. Is it not showing that? Let me do new share. Hold on. Here we go.
I was just going to say, try a new share, or I can stop.
Yeah. Let me try new share. There we go.
Okay.
Right. You see?
Hey, there we are. Awesome.
All right. Here we go. So this is the refund schedule for the single and split edge up front, and then it would also include customized now. So as you can see, so this column E is really where I refer most people to. And as you can see, it's within 36 months. And that is if you are going to sell or refinance the home. These other columns are based upon just HPA, which means they are still retaining the home. And, it's met either, whatever the criteria is for that. And I do actually have a flyer that I can share with you as well that shares the agency guidelines on that. But typically 36 months. So example, that particular loan had closed in November. So what, 6-7 months had passed by. So they would have gotten, 78% of their upfront premium that they paid. And they paid $11,000. And whenever we did the calculation, they would have gotten $9,000 back, that particular customer, if they had picked the refundable option. Okay. So now that, let's see. Let me share, go back to the presentation. And I'll send this over to you, Susan, if you want that.
That would be awesome. And I'll make sure for any of our non-members in here that we will email you a copy of this. And for our members, we will put this in the resource center.
Yes, absolutely. But again, like I said, I always encourage you, you have to go back and check what is acceptable with your internal compliance department and your investors. Because these are just, like I said, these are the products that are available that we're giving to you, but you have to make sure that it does meet your investor guidelines. Okay. But again, like I said, I just always really encourage that. Now, the other option, we're talking about just the upfront singles, also our split premium. So let's just say you have additional seller funds left over on the table. You can also pick the option to go out and well, we now have actually the cost customized, and I didn't have this previously. So let's just say there's $500 left on the table. You can, I know back whenever I would do it, I would either do an extended home warranty or something along those lines. You can actually utilize that to maybe reduce your borrower's premium. And I'm going to go do a live demo here with you and kind of show you how our pricing tool works, so that you can see how to go out and look at those different scenarios as far as pricing that out. And again, so here, this is just comparison to FHA and our monthly, our single, and our customized, but I like to do a live demo for this portion. But again, like I said, there's times in this particular one, and you can see the upfront premium rate for an FHA is 1.75 and ours is 1.59. So there are many times that actually conventional pricing is a better option if the borrower, obviously fits within the guidelines and within your investor guidelines. So what I'll do next, I'm going to share with you. I want to share my live screen. Give me 2 seconds. All right, let me share with you a different. All right, so are you seeing my screen? What are you seeing right now? I just want to make sure
I'm seeing your website where you can price out different options.
So you see all those? Okay.
Yes. So if you want, maybe put this link into the chat so they have it. I use this all the time, and I think it's a wonderful website to help us kind of figure out what works best.
Yeah, it is radian.com. And so if you want to,
I'm going to put that in there for you guys.
Yeah, right. And then right here at the top, you would click this MI rate quote. Because whenever you go initially to the screen, this is kind of what it looks like. Go back to, this is what the main screen looks like. just the radian.com. So this is what it'll look like whenever you first come in. You're going to want to come in here to the miradianquote.com. And I'll show you later too, after, if you don't mind, I'll show you some other tools that are available within this website.
That would be wonderful.
Our training. Yep. Yeah, that's all of our training. Yeah, absolutely. Absolutely. So here, so I'll pull back up this this original quote. That I had kind of set up and started. So here's an example of a quote that I ran earlier this morning. And as you can see, the upfront, the single premium is 7.1. So if you were looking at a loan that you were maybe potentially going to do an FHA loan, this would be a better option for your borrower, because you could finance this, the 1.71%, which would be less than the 1.75, and you would no longer have monthly MI. So a lot of times you can, look at that to qualify. And this is actually the refundable option that was part of the quote. I'll go down here and see. So what I'm going to do is I'm going to modify something here real quick and show you. Give me just a second. I'm going to edit it so then I can kind of show you how you can run 6 different scenarios within our tool and find something over. So all I'm going to do is I'm just going to do 701. That's enough. All right. So what you can do whenever you go into our tool. So right now, the one that I'm looking at is the borrower paid single refundable. One key thing I want to point out here is our quote ID. Always keep that information, and I'll show you how you can have it either PDF or email to yourself. But that we have a 90-day guarantee. So as long as there's no criteria that has changed on the loan, and that means any of the same things that, whenever you're running a DU that would change and impact your AUS, then this quote is honored. Okay. So I just want to show you all the different scenarios that you can run. We'll go ahead and compare the monthly. We'll leave this the non-refundable. We'll go ahead and compare our single and the non-refundable option compared to the two. And as you can see, it's about $500 difference between the two. But again, so let's just look at this scenario. The borrower closes right now, and they have they're paying $10,260. They use builder credit, whatever that may be. If we go and we look back at our refundable schedule, if they close in even 12 months, they're going to get 69% of that back, which would be, well, let me do this. Where? They would get $7,000 back. Now, the other opportunity that you have here is if you also have someone who's using DPA funds. I know there's a lot of the down payment assistance programs that are requiring repayment. And so instead of the borrower, necessarily having to utilize maybe a house, this will also assist them if they happen to have to resell or refinance when they're utilizing DPA funds. They can utilize this as an opportunity to, again, if they buy out the MI and they use the DPA funds for that, they'll have a refund. So again, another creative way to help the customer even in the next transaction. Does that make sense? Did I explain that right? I apologize.
So absolutely, it makes sense to me.
Okay,
it's a great idea.
Okay, good. Yeah, I just think it's a great opportunity, and I have been actually talking to a lot of the housing authorities as well. I have talked to Colorado, talked to Utah, talked to Arizona, the states that I'm in, and also just reminding them of that whenever they're doing any of their trainings as well, how to utilize MI to potentially assist that consumer on the next transaction. If they have to sell or refi that, maybe look at this as an option as buying out the MI on the single premium and utilizing those DPA funds. So I'll just show you again. So I'll do a few comparisons here. I'm gonna pick the borrow, maybe. I'm gonna show you our customize. I'm gonna go ahead and I'm gonna pick the refundable option here. And so that option that I picked, if you noticed, I probably went a little too fast. It's half up front. They pay half up front. This is, what the fee may be. But let's say that this is what you have and you have, additional seller funds, or you need to get the payment to a specific amount, right? So right now the monthly premium is 180, unless just say you need it to be 150 in order to get the customer to qualify. You can go into our calculator and it'll tell you how much needs to be paid to get you to that figure. So you would more than likely pay the 0.75% to get to that figure. Okay. Or let's just say you have left on the table $500 seller funds and you don't want to let that go to waste for your customer. You can go in here and you can calculate it and it'll tell you how much it's going to, save you. So that's showing you pay the 0.125 up front, which would be the 750, and then this would be your repayment. So this is something new to us. And like I said, we are working with the integration in Encompass to be able to have this so that whenever you're running it in Encompass, you're able to see this. Okay.
Are you guys planning on working on this with Arrive, which is becoming more and more popular every day?
Arrive?
Yeah, Arrive, the LOS.
Arrive is more, I know more on the wholesale side, but I have not heard as much about it on the Arrive side as I have Encompass, but definitely something I can ask. Because I know Arrive is actually more of the wholesale side.
Yes.
And I do have a lot of, I have actually several wholesale accounts. But what I want to show you too here is so you can run up to 6 quotes. So I always encourage folks, I know it's maybe frustrating to go outside of your system to have to do this, but it actually is easier because I personally have worked in Encompass before. And I know that you change one thing in one screen in Encompass and 10 other screens are messed up. So this is where you can kind of go out and play around a little bit. And you can get up to 6 different quotes out here. And so you can play around with, again, just whichever, like monthly, if you want to do the refundable option, you can go in here and just see our pricing. So you can run 6 different scenarios. We are working to potentially add in a comparison for FHA and buy downs. We haven't got there yet, but again, right now it's definitely giving you some creative tools as far as pricing out and seeing what you can do to utilize the MI to get your borrower to qualify. And so that's the reason for, I think, this presentation mainly is just to give you that tool so you know that is out there, and to remind you of the finance option, remind you of the refundable option, to make sure to use that as a creative tool for, maybe even the next transaction, because I think that most borrowers that are purchasing homes today are going to be your next refinance in the next year or so. So you want to think ahead for your customers. So those are some of the things. All right. And so now, I'll open it up to questions, whatever you may have.
Debbie, I have one question for you. If somebody chose the non-refundable option, and let's say 8 or 10 months from now, the rates went down quite a bit and there was a refinance, would they have to pay the $9,700 again? Would there be any savings left, or how would that work on choosing refundable versus non-refundable in a refi?
Correct. Yeah. No, they would not get any type of a refund. And if they do not have, the 20% down to remove MI, they would have to repurchase MI.
Wow.
Yes.
Thank you.
Yeah.
So just to add on to that, for anybody that is a mortgage broker in here, the only way we potentially could use that would be refundable. There has been a big discussion about this as far as why not as many lenders offer the financed MI to mortgage brokers. And it has to do, of course, with tolerance because it's included in your APR. But if it's refundable, just like FHA MI is refundable to a certain point, then it may not necessarily have to be calculated into the tolerance. So for anybody that works for a mortgage broker, as Debbie said, first of all, you have to check with your lender to see if they will even permit you to do this. And then it would only make sense to really do it as a refundable option. And I think in today's higher interest rate market, 3 years, I think is what you said, Deb, is the average for the refund.
Correct. Yeah.
So based on where the rates have been over the last 2 years, I would say a refundable option would be a better option for your clients because we will come back into a refinance market eventually, and we want to make sure that they're getting that back. And again, that is up to the servicer, whether they refund the actual money or take it off the balance of the mortgage during a refinance.
Now, if it's MI and it is truly refundable, it would always go back to the customer. It's not like a buy down. So I can tell you that if it is allowed, like I said, for you to close the loan that way, then it would, if it is MI and refundable, it would always go back to the customer. So that part is for sure. But like I said, a lot of folks, because the first 1.75% on the refundable option should be out of the QM test. But again, every investor is different on how they look at it. Every compliance department, every company is different. So you always have to ask those questions in advance. I'm giving you, like I said, I'm giving you the tools that we have and the products that we have that are available, but you always have to, default back to your compliance department and your investor on what they will take. But typically there are some companies that we do know take that into consideration and remove the first 1.75% of the MI out of the QM test. But again, that's investor by investor.
Another question, Debbie, would be, let's say we have the option of selecting our mortgage insurance companies, which a lot of times we really are not told that we have options, whether we can go to Radian or another mortgage insurance company. Is there a workaround to that? Do you work well with brokers through specific lenders? We know that UWM has their own deal. So we know that this will never happen with like UWM, but
Right.
Do you have a relationship with other lenders where we as brokers could actually go in and request Radian?
Mm-hmm. So again, it would be your lender that you're working with. We don't work with UWM. So I just want to point that out, that we don't participate in their way of doing MI. So they are not one, but I can say I have two really large. I work with the Loan Store, and I work with Resi Central, are two of my bigger accounts. And again, I encourage every single customer that I come across to have all 6 MI companies, because in this environment, you want to make sure that you're getting the best rate for your customer, which is really, really important. Now, granted, if there's a tie or we're close, please pick Radian, please. But again, we want what's best for the customer. I mean, that's just our approach. I do have, like I said, those two major wholesale lenders, and they utilize me quite a bit. Again, we try to, keep our pricing in line, but where that helps is getting quotes and kind of seeing if we're out of line. I can send to my pricing team and say, hey, this is the quote I'm getting. What's going on? Why are we out of line? So those are important. So if you pull quotes and you see that we're not, please email those to me. That helps me a ton. But you know, again, I do. I have you know, some that's, well, I'll give you an example. One of them, one of the two, I won't tell you which one. They weren't really using us at all, and a broker is the one who sent in and said, "Hey, I need you to look at Radian pricing," because they were selecting a single MI company, and so it kind of opened the door for them to start looking at everybody's pricing. So
Right, because
long,
everybody's pricing is a little bit different, correct?
you bet. It's, yes, best as it's no different than your than you know than wholesale pricing. It's almost identical, right? It depends, and it can change every day.
Now, what
So
would you say are the key factors to determining the pricing on mortgage insurance besides the loan to value?
I would love to give you that list, but honestly, there are so many factors. So I'll give you
So could we
the
do an example on here? Like maybe there's somebody attending that would want to give Debbie maybe an example of what of a loan that they are working with where this may actually benefit them, please?
do a new profile. Yeah, because again, it's very dynamic. It's much like, so well, I'll give you a quick scenario, and this is what my manager actually shares, and it's so funny. So we used to have 2 people in our pricing department. We now have 16. And one of the gentlemen that works in our department used to work for NASA.
Oh,
So
wow.
there's so many factors that are involved in pricing today that, I mean, they don't even give us that information. So it's very detailed. It's very, you know, there's a lot of derivatives in there, and honestly, we don't have all of the information. So that's why
Right.
we always encourage, oh, did we win pricing today? Good. Okay, great. We won today. Yeah.
So
If there's just yeah.
so if you scroll down on this screen, just for
Mhm.
example, and you go up to where the credit score is, what would happen if we put in, let's say, a credit score of 740?
Okay, let's go.
Ooh,
Yeah, look at that pricing.
wow, that's amazing.
So do you see what's, and so here's your refundable, but here is a perfect example. Right here is a perfect example. And thank you for giving me that, of non-refundable and refundable option. Literally $300. But imagine if the borrower refinances in 12 months, they could get 69% of that back, or they get 0. And
Yeah, I'd
over
want the
$300.
69% back. Absolutely.
Yeah, exactly. Yes, for a $300 difference. And it's just understanding that piece of it, that it literally, because before, I mean, years ago, and again, I'm sure most everybody on this call has been in the business for a long time, it was a bigger spread between the refundable and non-refundable, but MI has, you know, transformed, and a lot of people don't even realize that it's not that big of a spread anymore between the refundable and non-refundable option. And that's kind of why I'm trying to, you know, get out there and educate folks, and give them that tool, because I think it's something that's really going to help you.
Absolutely. Now, I'm curious, how would the refundable work on a monthly MI? Would that really make a lot of sense?
Well, you know, and that depends. Yeah, that depends, because you're not paying anything necessarily up
Up
front.
front, right?
Right. Yeah. So, yeah,
And then
that
what was
that
the
would
loan
be
to
as
value
that
that
would
you
just be
used
based
on
on what you
this?
paid. Yeah.
What was the loan to value that you used in this sample?
This one was a 95.
It was a 95. So if we reduced it to a 90, that would lower it even more, right?
Oh, I'm sure. Yeah, we can edit it. Yeah, let me change it to a 90. And that's why I love this. I love getting out. I'm a nerd on this stuff, but I love getting out and play with it. So I'm
I
glad you give me
know.
examples. I do, because it is. You just never know. And again, that's why it's here. So
Okay,
yeah. So
yeah.
you can pay out too. So if you even have a 90, right? Just yeah.
Yeah, this
Well,
is
and the
awesome.
one I always like is sometimes your pricing is better. And I don't know if a lot of you have done that, but like even on the secondary market, if you do the
85.
Yeah, exactly. Like the 80, even 82. Let's just do
82.
82.
I know. I've seen that because
I mean,
80,
so it,
you
yeah,
actually
so
will
you,
see higher interest rate than you
yeah,
would at 81, 82 because you
yeah,
have the mortgage insurance to back the loan.
yeah. So let's
Oh,
just say
wow.
82. Yeah, exactly. I mean, it's super cheap. So those are your options. But I think that's again, like I said, I think it's a lot of the things that we forgot. I know I forgot. I have to be honest. I don't think I've done the financed option since the 90s. To be quite honest, as far as MI, of course, FHA has always been financed, but on the conventional side, I haven't done the financed option in years.
Yeah, the
And if
last time
anybody's
I
new
did
to the
it, I think
industry,
it was like 2000, maybe 16, 2017.
yeah, I mean,
When I was actually working for a bank, and I
yeah,
would do it quite often because it did make loans that other lenders couldn't do because you're eliminating that monthly.
right. Well, and a lot, and because maybe they didn't know, honestly, because anybody that's come in the business in the last 10, 15 years, and let's just be honest, since if you think about, I guess, when the crash happened, a lot of people came in after that, which is probably in the last 10, 14 years. They've only done monthly. That's it. I get what for each of my accounts, I have what's called an insight report, and it shows what the lenders are selecting as far as their options. And whenever I first started, a little over a year and a half ago, everybody was just the monthly premium. Nobody was utilizing the singles, the splits, any of that. And so I am now, because I've been out and trying to educate, some of my accounts, I've been showing them different options. I'm starting to see an increase. It's not it may not be, it's not a lot, to be quite honest, but still, if it even helps you save one deal, I mean, I think right now in this environment, that's critical. So,
Oh yeah, I totally agree with you. I mean, that's why I love this presentation because a lot of people aren't aware of it, especially people that haven't been in the industry as long as we have. But like I said, this was something that was very popular that I used all the time with banks when I worked for banks,
correct.
but not as much with the mortgage broker since the Great Recession.
Correct.
But everything's always opening up and education is key. Does anybody else have any questions for Debbie? She's in Mexico, by the way, on vacation. So I really appreciate you taking time out of your vacation to share this with everybody.
Oh yeah, no problem. Absolutely no problem. Actually, I am back now. I was in Mexico.
Oh,
I'm back
well, I'm
today.
so sorry to hear that.
No, I know, me too, because I wanted to stay there, but
So
I'm back, but I'm still on vacation.
when you send me, if you could send me PDFs on the different charts that you showed, I would love to share that with everybody today. And again, like I said, I will absolutely put this all in the resource center. And I think the canceling of this flyer that you're showing right now, I think this is a really important flyer that we should be sharing with our borrowers, just so they have an understanding as well.
Well, and I think what I share this with loan officers, and I know it's funny that everybody thinks, why would you want to cancel MI? That's money out of your pocket. But again, Radian is always about the consumer and about doing the right thing. And so that's why we have this. But this is a great tool, I think, for all of your loan officers to have and somewhere close, because it gives you the guidelines. And a lot of people, because I'll have customers reach out to me and say, hey, I want to cancel my MI. Well, you can't come to me. You have to always go back to your servicer. They are the ones who determine whether that can be canceled or not. They notify the MI company, and then that's how the process gets started. But this is a great tool for your loan officers whenever they have questions of where to go as far as the agency guidelines. But also, it's also a talking point for them to reach out to past customers that maybe they think have enough equity in their home. And you may, you may be at a spot to, if nothing, just making that connection. You might have a refinance, you may have a purchase, but it's reconnecting with your consumer. So I think it's a great tool to utilize in that way. So that's the other way I encourage loan officers to utilize this. So
yeah,
I'll
this
send
is a
both
really
to
great
you.
marketing tool. You're right, to stay on top of your clients and customers. I would definitely be looking through my pipeline today to see who may qualify to have their mortgage insurance dropped. And it's a great way to start that conversation and stay top of mind with your borrowers.
Yeah, agreed. Absolutely.
All right. Well, if there's not any questions, we're going to let Debbie go. I did just, I did want to also real quick with everybody in here, let you know that we've done some updates to our website that I just want to point out to you real quick. We have added a new free tool to the website. So besides being able to download the free ebook, which goes over a lot of guidelines, we also have free resources now where you can go in, and we have different mortgage calculators now, payment with amortization, your loan comparison. This is all free to anybody that logs into www.crimat.com. And of course, we always are updating rates, but please make sure that you understand that these are just nationwide averages and not specific rates to be quoted to anybody. So with that being said, everybody have a fantastic day. And again, thank you so much, Debbie, for taking time out to do this presentation.
No problem. Thank you for having me. I appreciate you.
Oh,
take care.
Absolutely. Thank you. Bye, everybody. I'm going to be
Bye.
opening the loan mortgage support room in about 10 minutes. So if anybody needs or has any questions, feel free to jump in.